Hi, my name is Annamaria Kiss. I am a tax supervisor on the international team at KB. In this video, I would like to talk about cryptocurrencies. What are cryptocurrencies? In the simplest of terms, cryptocurrencies can be defined as digital assets that are designed to work as a unit of account, a store of value, and/or a medium of exchange. It can be used as a substitute for money. Cryptocurrencies rely on an encryption technology called cryptography to sort and transmit data over the internet. Protection of the transmitted information is achieved with the use of asymmetric encryption keys. One of the keys is public and the other one is private, known only to the owner. You probably heard the term blockchain. The blockchain is a decentralized database consisting of blocks of computer code linked through cryptography. Once created, the information within a block cannot be altered. New data can only be added in the form of a fresh block. Each unit of cryptocurrency has a unique code and timestamp that cannot be duplicated. The blocks can store various types of information, just to name a few: payments, money transfers, accounting records, journal entries, medical records, records of prescription drugs, and real estate title. But it can also be used for copyright protection and even protecting voting records. The possibilities are basically limitless. To date, the most widespread application of the blockchain is in the form of cryptocurrencies. While the jury is still out on cryptocurrencies, there is a consensus that blockchain technology is the way of the future. Let's talk about mining. Mining is the process of validating the transactions recorded in the blockchain ledger by solving complex mathematical equations. Sounds simple. The process requires specialized computer equipment, specialized software, abundant energy supplies, and cold air to keep the computers from overheating. It is not surprising that some of the first and largest mining operations are located in Iceland and Siberia. So why do it? The first miner to validate the new transaction on cryptocurrency blockchain, on a specific cryptocurrency blockchain, receives new units of that particular cryptocurrency, or perhaps a fraction of it, as a reward for their efforts. Hence, new cryptocurrency units are created. The first cryptocurrency, Bitcoin, was created by a developer, or perhaps a group of developers, nobody really knows, who used the pseudonym Satoshi Nakamoto in 2009. Since then, the value of Bitcoin rose from virtually nothing to well over $35,000, maybe even $40,000 by the end of the first week of 2021. The most common types of cryptocurrencies include the following: Bitcoin, Ethereum, Tether, Ripple, Litecoin. And at the time of this recording, there are over 7,800 different types of cryptocurrencies, and the list grows every day. Let's talk about a few different terms. A cryptocurrency wallet is a software program that stores private and public keys and interacts with the blockchain. It is essentially a storage for the unique code and timestamp of each unit of cryptocurrency. The wallet enables the transfer of virtual currency you can send or receive, and monitors the balance at the same time. Soft wallets can be offered, for example, as an account by a cryptocurrency exchange, or downloaded as an application to your smartphone. Hard wallets or hardware wallets are also available. They look kind of like thumb drives. Cryptocurrencies are traded on cryptocurrency exchanges such as Kraken, Coinbase, Gemini, just to name a few, but there are many, many more. An airdrop is a distribution of units of a newly created cryptocurrency to existing wallet addresses in the hope of generating some type of hype for the new cryptocurrency. The distributions take place without consulting the owner of the wallet. A hard fork occurs when the blockchain of an existing cryptocurrency diverges into two paths. For example, the split between Bitcoin and Bitcoin Cash. Following the 2008 crisis, the financial sector has been experiencing some, let's call it, loss of credibility. Cryptocurrencies soon emerged to provide an alternative to the traditional banking system. Additionally, there are people living in developing countries who simply don't have access to banks, but can use cryptocurrencies to finance their everyday life or perhaps a small business venture. For every successful cryptocurrency, however, there are dozens that fail, rendering the initial investment in those cryptocurrencies essentially worthless. Many cryptocurrencies with weak security in the code have been hacked, the money has been siphoned off, login information, of course, can be stolen. The damages to date are in the billions. Additionally, cryptocurrencies have been known to be used on both the regular and the darknet to finance criminal activity such as illegal trafficking of children, financing terrorism, illicit drugs and arms trafficking, and all kinds of nefarious purposes. So why do we care? Generally, income is taxable unless specifically exempted by law. Income from cryptocurrency transactions is not exempted by law. Due to the astronomical rise of cryptocurrency values, the IRS has become interested in the subject. Various court cases followed and granted the IRS the right to force cryptocurrency exchanges to turn over client and transaction information. Therefore, the IRS is now obtaining records of virtual currency transactions and expects to see those items on tax returns. In 2014, the IRS defined virtual currency as property for federal tax purposes. In 2018, the courts granted the IRS's John Doe summons against Coinbase, the largest US cryptocurrency exchange. In this case, the IRS was asking, let's say, Coinbase to turn over transaction records involving cryptocurrencies for amounts over $20,000. For tax years, this was for tax years 2013 and 2013 through 15. Also in 2019, the IRS started to mail educational letters to taxpayers who were suspected of failure to file and report income and pay taxes from cryptocurrency transactions. And also in 2019, the IRS commissioner himself wrote a question regarding virtual currencies, which is now added to the tax return. This question must be answered. The IRS likes to call cryptocurrencies virtual currency. So going forward, I may be using the terms interchangeably. For 2020, the question is the following. At any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? The question for 2020 is moved to page 1 of the tax return. It is the very first item directly underneath the basic taxpayer information. This change in location shows that the IRS is moving from educating taxpayers towards enforcement. For the first time ever in 2020, we also have some instructions. The draft instructions define virtual currency transactions as receipt or transfer of virtual currency for free, exchange of virtual currency for goods or services, purchase or sale of virtual currency, exchange of virtual currency for other property, including other types of virtual currency, acquisition or disposition of a financial interest in a virtual currency. Let's take a look at an example. Gain or loss from the disposal of a virtual currency that is held as a capital asset is subject to income tax and is reportable on Form 1040, Schedule D. The following is a hypothetical and very simplified scenario. On January 1st, 2015, taxpayer A purchased 10 units of Bitcoin for $315 each for a total cost of $3,150. On January 1st, 2021, when the value of Bitcoin reached $30,000 per unit for the first time, our taxpayer decided to sell for total proceeds of $300,000. The reportable and taxable gain on the 2021 return, ignoring all other factors, equals the difference between the process, the proceeds, and the original cost, somewhere around $297,000, almost. If we assume long-term capital gains rate of 20%, the tax payable is $59,000 and some change. Another example, activity carried out in a trade or business is reportable on Schedule C for self-employed taxpayers. Another very hypothetical and very simplified scenario. On January 1st, 2021, taxpayer B decided to mine Bitcoins. Our taxpayer purchased the mining software, specialized hardware for $20,000. And since our taxpayer is a student and lives with their parents, they don't have to pay for electricity, so we can just ignore that. On January 1st, 2021, the same day, the taxpayer mined one Bitcoin that was valued at $30,000. Our taxpayer does not intend to mine any additional coins during 2021. The reportable and taxable income from the mining activity is again the difference between the value of the Bitcoin and the costs related to the mining activity. We can call these costs expenses as well. The income is $10,000 in this case. Assuming 12% tax rate and ignoring all other factors, the income tax would be $1,200. The self-employment tax for an assumed rate or 15.3% is $1,530, and our taxpayers' net income after expenses and taxes equals $7,270. In other news, the Financial Crimes Enforcement Network proposed rulemaking to combat illicit finance activity. They are proposing to require banks and money service businesses to keep and submit records of transactions with wallets involving cryptocurrencies or virtual currencies as they like to call them, and also to verify the customer's identity. As of December 22nd, 2020, the Securities and Exchange Commission filed suit against one of the more popular cryptocurrencies called Ripple, alleging that the cryptocurrency is in fact an unregistered security offering. Within days, Coinbase, the US cryptocurrency exchange, was also sued by a customer for illegally selling Ripple tokens. I hope you enjoyed this presentation. I thank you for your attention.